Okay. All right. Well, good afternoon. Thanks all for coming around. As Tom mentioned, the name's Craig Field. I have a small practice in Matthews and Valentine. We do taxes and financial statements, typical public accounting stuff. Also the Charlotte representative for Russell Bedford International. That's an international network of accounting firms. We've got 11 representatives in North America and quite a few in South America, and the rest of the world we're very well populated. So if you need international tax help, then please give us some consideration. I want to try and do this as conversationally as possible. So if you've got questions or issues or thoughts that come to mind, let me know. I think it's useful for everyone to hear real life situations. As for changes in the tax code, 2022 is a little bit quieter, thank goodness, than it has been the last couple of years. We had two pieces of legislation that went through. One was the Inflation Reduction Act pretty early in the year, and the other was the Secure 2.0 Act, and that's because it's the second time they've issued a Secure Act in the last couple of years. Julie will cover the Secure Act in just a little bit. The other thing I want to touch on is the Tax Cuts and Jobs Act. That's the old Trump tax cuts that everyone talks about. They were effective 2018. They're set to expire in 2025. That'll be the last year. So we've got 3 more years of those cuts. Perhaps we're thinking about what the impact of that legislation is. And then I'll touch on a couple of credits and tax issues that are relevant to this year versus the prior years. So, Inflation Reduction Act affected both businesses and individuals. Some of the impacts on businesses are a 15% minimum tax on corporations, but that's only if you made $1 billion or more. So I don't know how many of you that applies to, so it doesn't apply to me. Oh, there we go. Well, you have clients. $1 billion profit. There you go. That's effective from 23 onwards, so don't worry about your current tax return, you'll be fine. 1% tax on stock buybacks. Now, I guess you're probably going to say, well, that doesn't apply to me either. But just think about this for a moment. Most stock buybacks are done by big corporates to keep the number of shares in issue at a relatively constant level. Many big companies pay employees via stock compensation programs, right? And they're very lucrative. So if tax buybacks are going to be penalized, taxed, are big companies going to stop doing that? And if they stop doing that, does that mean they're going to cut back on employee retention programs? So anyone who, I don't know if there's anyone here on an employee, on an ESOP or an employee stock option plan, but certainly a lot of my clients have them. Are they going to stop? Will they not be getting those in the future? And then we'll touch on it a little bit more. In energy credits, there's a big emphasis on efficient energy. So efficient energy credits that have been around for a long time now, they've been extended and they apply also to businesses. So go to energystar.gov. That's a well-known website, energystar.gov, or talk to your accountant about whether your business energy, whether improvements to your business premises would qualify as for a credit. As far as individuals go, continuing the theme of efficient energy, there's a 30% clean energy credit that's available, and that's effective immediately. So if you did something in 2022, well, then that's great. You can get a tax credit of 30% of expenditure for things like solar and wind power systems, water heater systems, HVACs, heat pumps. Obviously all got to be energy efficient. Energystar.gov is a great resource to see if your equipment does qualify for that credit, and you can claim credits up to $14,000. All the states have different rules, so check with your accountant whether you can get a state credit as well. Electric vehicles, the credits for electric vehicles have continued, $7,500. Remember, you may have heard this, Tesla lost out on theirs. The legislation for the $7,500 credit was limited by manufacturer. So if your manufacturer reached the limit of number of vehicles that they sold, then you no longer got the credit. So I have 2 clients right now who just purchased BMW. I think it's an i4 in place of Tesla because they get the credit. And Tesla doesn't give you that credit anymore. But you can get a $4,000 credit on used vehicles now. Criteria generally are that it's going to be clean, which means basically plug-in electric, but it could also be hydrogen cells. I don't know if there are any hydrogen cell vehicles out there. Has to be assembled in North America. Trucks and SUVs priced under $80,000 qualify. Normal sedans and that sort of vehicle under $55,000 you qualify for the credit. And there's an income threshold as well. Married filing joint income earnings of $300,000 less, you qualify for that credit. Affordable Care Act premium subsidies. You may be aware that there were some improvements in premium subsidies during COVID, 2019, 2020, 21. Those have been extended through 2025. Medicare caps. So Medicare is now being allowed to negotiate. I don't know if you knew this, but Medicare previously was not allowed to negotiate drug prices. That is now being phased in. So they will be able to start negotiating drug prices. And Medicare beneficiaries, seniors, will have their prescription drug costs capped at $2,000 a year from 2025. So that's quite a big bonus for seniors. And then everyone heard about the 87,000 IRS enforcement agents going to be employed. What the legislation provided was $80 billion over 10 years for the IRS to employ additional staff. And they were targeted as tax enforcers. But what I'll just say to you, and this is just opinion, the staffing of the IRS right now, and they're at the building next door, the Charlotte office, staffing the IRS right now is in the middle of 80,000. So over the next 10 years, you can expect a significant number of them to retire, move on, get other jobs. So does that 87,000 new people, are they just going to come in and replace, or are they really going to be used for audit and enforcement? I don't know. From a personal perspective, dealing with the IRS, they really could do some help in customer service. The agents that are there are great, but my golly, they're stressed. It's impossible to get through to them. The times that I have, they're fantastic. They really help you out, and we really get stuff done if you can get through to the IRS customer service agents. So why the focus isn't on that, I don't know, but I guess it's not politically palatable or whatever. Yeah.
Back to your original, your slide just before this one, quick question. If I obtained an electric vehicle, $10,000 used Prius, did I understand that previous slide that because it's a used vehicle at pristine condition, that there was a $4K subsidy potentially?
$4,000 credit, but I'm not sure if Prius qualifies. Do you know? I think it has to be plug-in.
It's a plug. It's a I'll tell you.
Okay, if it's a plug-in,
it's got to be plug-in, and it depends also on the cost. There's kind of a crossover point there.
Right.
So there's some details you got to look into.
Yeah,
no, you can't just buy one from your friend and get the.
But yes, that's a new thing that you're not getting it on used vehicles, which is quite nice.
Yeah, that's weird used. You're going to be sending us this deck after the program, or should we be taking pictures of all these slides? Can you share it? That's what we're asking.
I could share it. If you want to just leave a business card with me, I'd be happy to.
Thank you.
To send you the electronic version. Tax Cuts and Jobs Act. This was quite a boon, I think, certainly for a lot of my clients and small business owners. This was quite a nice piece of legislation. With it going away in 2025, and it's not guaranteed that it will go away. You know what politicians are like when they give something, they're very reluctant to take it away. So it may well be that this gets extended, but who knows. But the effect is the tax rate, the maximum tax rate prior to this act coming in was 39.6%. It was dropped to to 37% for, and that was on the bracket. So you understand the concept of brackets. If you have income in excess of $693,000 a year, taxable income, that gets taxed at that maximum bracket. Well, back in 2017, that maximum bracket was only $470,000. I say only $470,000. That's still a chunk of change, but yeah, it's $200,000 off what it has been the last couple of years. So a lot more people are going to fall into that bracket, and obviously single taxpayers and married filing separate and head of household have similar adjustments. Tax brackets, all the other tax brackets adjust as well. So I'm not quite sure how we're going to square the circle with people under 400,000 not having to pay more tax, because as you can see the tax brackets did change, so they would have to change the tax brackets to allow them to exempt people under 400,000. Then the big one that a lot of my clients enjoyed was the qualified business deduction. So if you have a pass-through business, which is most people, either a partnership or an S corp or even a sole proprietor, Schedule C, you qualified for a deduction of 20% of the profit on that business. That's set to go away as well. It's a huge piece of legislation. The impact of that, I don't think anyone really considered. Typical with tax, the concept comes out, we're going to give you a 20% deduction on this, and then what's this? And the IRS spends the next 2 years issuing regulations and policy statements on what this is, as defined. Deductions and credits. One thing I think is important to notice is I just wanted to highlight this child tax credit. Last year was a real boon for people getting, particularly children, because you got $3,600 if you had a child under 6. You got $3,000 under 17. That's going to drop back to the usual level of $2,000, which is still a decent credit, but it's way different from what it was in prior years. We spent a lot of time last year doing bookkeeping for our clients in the IRS, because a lot of those credits were actually advanced. So my clients would say, oh no, I never got a child tax credit. And then you send the tax return in and they say, well, why is my refund less? And you go say, well, you did get the child tax credit. Oh, well, my wife never told me she got hers. So you end up trying to reconcile that bookkeeping. We won't have that this year, because we don't have any of those advance payments. We don't have the stimulus checks. So we're going back to $500 for 17 and over, $2,000 for 16 and under. Just note, it's under 17 is when you get that child tax credit. It's not 17 and under, it's under 17. The child dependent credit is interesting as well. If both parents work, and it has to be both parents working, and they pay for dependent care, so that can be after school care or that kind of thing. Last year, 2020, I should have said 2021 there. Previous year, 2021, you got 50% of up to $16,000 as a tax credit. That's going to drop to 35% for only $6,000 worth of dependent care expenses. So big change in that. I've included the tax brackets for 2022. Not sure if that's really relevant. It's just bean counter stuff, lots of numbers. But I thought this might be interesting. I've seen some comments on whether the Tax Cuts and Jobs Act cost money, cost the country money. Have we got deficits because of the Tax Cuts and Jobs Act? Well, Tax Cuts and Jobs Act kicked in 2018. Total revenue generated by the US government for each of those years is listed from 2015. And you can see that the total revenue collected by the US government did not change. In fact, went up from 2018 onwards. So it continued the trend of the prior years. So the Tax Cuts and Jobs Act did not change the amount of revenue the government was able to collect. And that's a pretty, I mean, from my knowledge of international tax, that's usual. We usually find tax reductions do not actually affect the amount of money the government is able to collect. Whether it affects GDP growth is an interesting thing. And you can see I put in the GDP growth, because I mean GDP affects us. How much money are we actually all making every year? And 2018 was a bumper year. We had 2.95%, and then of course COVID kicked in. So 2020 and 2019, we saw the drop, and then of course the most recent year we've seen the pick back up from the V-shaped or U-shaped recovery from the COVID. So I don't know that there's any trend there necessarily, but it certainly isn't detrimental. Whether it's positive or not, whether tax policy can affect GDP growth, I'm not sure. So just an interesting thought, folks to think about. And then if there's anything else you want to ask, I'm available. Otherwise, I'll hand over to Judy.
Thank you very much for that introduction. I'm a tax and business partner with the law firm of Darrow Everett, and I've been, I try to put it in employee benefits context. I started practicing tax law after ERISA, but before HIPAA. So I came in and there were all these people who knew all about ERISA, and I had to catch up and learn a few things. But employee benefits is part of tax, and certainly we're going to talk about the fact that this is one of the largest pieces of retirement legislation since 2006. So this is very, very significant. And the point is to make things simpler. I tell people, when I first started practicing in the employee benefits area, there were a lot of things I didn't know. I was more sort of a corporate partnership tax person, and benefits was its own thing. What I tell people, there are 4 things to remember. Every aspect of benefits has to do partly with what the law requires, what the law permits, what your plan allows, and then sometimes most importantly, what your plan administrator says is possible. I have dealt in the benefit space for everything from Fortune 500 companies to small, closely held businesses, and it isn't, in some cases, it's one size fits all, and in some cases it's not. And certainly the Secure 2.0 Act both requires things for employers of a certain size, but also gives some options as well. So I just lay that out to kind of set the table for people who don't regularly deal with employee benefits issues. Okay, expanding automatic enrollment in retirement plans. This is huge. This is probably the most significant piece of this legislation in my mind. Beginning in 2025, the same year that the Tax Cuts and Jobs Act, a lot of the provisions phase out, this will be phasing in. And all 401k plans will have to be eligible automatic contribution arrangements. That also means that if they sign you up, you have to be able to withdraw your money within 90 days. That's very important. So it's not mandatory for the employee, but the idea is that people who are not in the 401k plan will be automatically enrolled and have 90 days to get out. There have to be automatic contributions of somewhere between 3% and 10%. Again, this is back to the what does the law permit and what do employers decide to do with their plans. And the good news is that employers are going to have some time to figure this out. What do I want to do with my 401k plan? And if another important issue is that if no investment election is made, then the contributed amounts have to be invested in what are known as qualified default investment alternatives. That's another interesting thing about benefits law. Part of it has to do with labor and employment, part of it has to do with tax, part of it has to do with the fact that if you set up a retirement plan, whether it's a 401k, a pension plan, you are a fiduciary because you're holding your employees' money. And so it's very important with these automatic arrangements what kind of investment alternatives you offer and what is a qualified default investment alternative. And that is Alan's nodding his head back there, but that has changed over the years. What is a qualified default investment alternative based on how the markets go and as the result of all kinds of fun and exciting ERISA litigation. So, okay, another important aspect of the Secure 2.0 Act is the increase in the what's known as the age for the required beginning date for mandatory distributions. All qualified plans have a rule that when you get to a certain age, starting in April 1st of the following year, you have to start taking your money out, whether you want to or not. And the good news is we're all living longer, which is great. And that's part of the reason why Congress said, okay, required beginning date is now pushed off, starting in 2023. Right now, the required beginning date, I believe, is age 70, but it's going up to age 73. And in 2033, it's going up to age 75. I think that's interesting, just because 2033 will be the year that I turned 73. So it's gonna be, wait, no, wait, I might possibly want my money by then, or not. I don't know. But in any case, this is, again, this is a significant portion of the Secure 2.0 Act. The good thing is that if you're an investor and you're invested in a non-qualified plan, whether it's a 401k or an IRA, you can keep your money in longer. And if the market's doing great, that's a good thing. Again, this is one of these things where, again, this is the required beginning date, which doesn't mean you can't get your money out sooner. But that's a whole discussion for another day about how, you know, the permissible aspect of the law is about getting your money out. Okay, higher catch-up limit for ages 60 to 63. Back in the day, Congress realized that lots of employees either weren't aware of the power of saving and investment or the need to save and invest, so that typically older participants in a qualified plan get to make catch-up contributions. And the Secure 2.0 Act has done, it's currently, the annual dollar limit on catch-up contributions is $7,500 for 401k plans, $3,500 for simple plans, and that's going to go up starting for 401k plans in 2024 to the greater of $10,000 or 50% more than the regular catch-up amount, and for simple plans starting in 2025, the same thing. It's interesting. Nobody knows why it's a different effective date for 401k plans than it is for simple plans. People are wondering if that was a glitch. A lot of the, who knows how some of this tax legislation gets done. We could end up seeing some technical corrections before 2024 happens. Okay, emergency savings. As many people know, again, there are different rules about when you can get your money out of your qualified plan, and if you get your money out of a qualified plan, what Congress deems to be too early, you pay a 10% penalty on those early withdrawals. But there's a laundry list of exceptions. And a new exception has been added in the Secure 2.0 Act, and that's for emergency savings. You're only allowed, it's pretty small, you're allowed one distribution of up to $1,000. You have 3 years to repay that distribution, so it's kind of treated like a loan, only with different requirements than the plan loan requirements. And then if you don't repay that $1,000 within the 3 years, you can't take out another withdrawal. So it's kind of an interesting provision there. There's another savings provision in the Secure 2.0 Act, which is emergency savings accounts. And that's where employers are allowed to permit their non-highly compensated employees, that's a specific group of people. Every year the IRS issues guidance on what is a non-highly compensated employee. I want to say right now it's around $125,000, something like that. And all those people will get to set up these emergency savings accounts, and employers will be able to automatically opt their employees into these accounts, which goes back to all the issues that we talked about before, but they can only be, they have to be capped at $2,500. Alan, you've got your hand raised?
Yeah, is that within a 401k, or is that a separate kind of a business account, or is that their personal account that they can send money to?
No, it's a separate kind of account, but the idea is if the employee separates from service, then they can roll it over into an IRA. I thought that was kind of interesting. It's not, say, Although I am sure that some employers probably will try and do it as a separate account within their 401k plan. That's one of the things that, we'll talk about this a little later when we get to plan amendments, but there are so many different both requirements and options in Secure 2.0 Act. I think that we're going to see a lot of movement from more standardized plans, what benefits types call volume submitter plans, to more individually designed plans, which is going to create lots more work for companies. It's going to create lots more work for benefits administrators if they're third-party TPAs. I see Elizabeth nodding over there. It's also going to create a lot more work for the IRS when everybody sends in their plan amendments and asks for a determination letter. So I would say, we'll talk about this a little later, but I would say, get those in sooner than later. Do not wait until the very last minute, because it's going to be chaos. So, starter 401ks. That's another feature of the Secure 2.0 Act. Eligible employees will be treated as making elective contributions. This is where the employer makes a contribution, but it's treated as if the employee makes it. Qualified percentage is not less than 3% or more than 15%, and again, that's up to $6,000 a year. Catch-up contributions are permitted to up to $1,000. And I think that 15% number is very interesting, because as a benefits person, I've been hearing my entire career that everybody in this room, everybody should be one way or the other saving at least 15% of their income a year toward retirement. And I'm not saying that to give business to the financial advisors in the room. I'm saying that because that's what the pundits say that you will need in order to live the same lifestyle when you retire that you're living now, thanks to inflation and all these other fun things. Okay, coverage for part-time workers. This is huge. It used to be that you didn't have to put employees in your 401k plan unless they were at least 1,000 hours a year. The Secure 2.0 Act drops that down to at least 500 hours for 2 consecutive years and at least 21. So that means if, let's say, you're in a business where you have lots of high school kids, like my daughter working part-time, even if they get to that $500, you don't have to allow them in the plan. But this is going to be very, very important. Again, this is definitely, if there's any situation that's going to require employers to look at their plans and say, do I have to amend it? This eligibility thing is going to be huge, and not treating the eligible people as eligible is going to be an issue as well. We'll talk about employee plans corrections later, but this is going to be a big one for a lot of employers who have either part-time employees, seasonal employees. It's definitely going to be a significant provision. Okay. The good news is, although the age for the required beginning date for required minimum distributions has been pushed out, at the same time, the penalty for failure to take those required minimum distributions has been dropped from 50% to 25%, and if you fail, and if it's corrected timely, meaning within a certain amount of time that person's distribution is paid to them, the penalty is reduced from 25% to 10%. It's still better to always take the money out on time anyway and not have to pay penalties, and then of course call your friendly financial advisor and reinvest the money if you don't need it right now. But either way, this is again just I would say this is a positive aspect of the Secure 2.0 Act, making things a little easier. Okay, we talked about how we were going to talk about EPCRS, the Employee Plans Compliance Resolution System. Again, I mentioned when I started practicing law, it was after ERISA, before HIPAA. There were very few ways to correct errors in your retirement plan. There was something called VCR, voluntary compliance, and that was such a painful process. Lots of people would just wait for the IRS to audit their plan and catch up to them. The downside being that, let's say you don't do one of these voluntary correction things and the IRS sees a significant enough error. Back then, they had the option to disqualify your plan. You do not want to have your benefit plan disqualified. It is painful for both the employer, not to mention all the employees who thought they were putting their money away tax-free. So nowadays, one of the simple truths of benefit plans that I learned is that it's not a question of whether your plan is in compliance or not in compliance. The issue is how far out of compliance are you. There are so many requirements, it is virtually impossible to administer your plan perfectly. So it is really great that the Secure 2.0 Act has expanded the types of errors that are eligible for self-correction and the timing. You've got to show that you're really committed to fixing this plan error, and this is good. This applies to custodians of IRA plans as well, because as we know, all kinds of mistakes can occur, not just in employer-sponsored 401k and cash balance and all those other plans, but also in IRAs. For example, I'll never forget the conversation I had with my mother, where she once asked me, "Can I take a loan from my IRA?" And I was like, "No." And she's like, "But," I said, "No." So again, lots of people don't know that. Thank you. All right, so let's move on here. But this is, again, there's going to be lots more guidance coming out on what kind of plan errors can be corrected this way, but this is definitely one of the beneficial aspects of the Secure 2.0 Act. It's going to make it a lot easier. Okay. Retroactive first-year elective deferrals for sole proprietors, that is what it is. If you're a sole proprietor, you have your own plan, you'll have pretty much until your tax return due date to say, oh hey, I want to set up this plan and put money in it. So that's really awesome. This was always true for IRAs and SEPs, but it'll be true for other kinds of plans as well. So, unenrolled participants. Let's say you have employees who aren't in your 401k plan. You still have to send them a bunch of notices. This Secure 2.0 Act has reduced the amount of notices that those unenrolled participants have to receive and the number of times a year they have to receive them. You still have to give those employees anything that they request, and of course, I think that this is a question of what the law requires and what the plan permits and what employers want to do and what plan administrators want to do. I think that employers and plan administrators are probably still going to tell their employees about the benefits of saving in the 401k and investing, but there is this backstop now that employees won't have to get all these notices if they're not enrolled in the plan. Okay. Again, corrective distributions. There's for IRA. Let's say you put too much in your IRA. That's very easy to happen, but if they're returned by the due date of a taxpayer's return, they're not subject to the 10% early withdrawal act. The only thing is you just can't claim a deduction for that contribution that was in excess. Sounds fair to me. Okay, again, we talked about the plan amendments. The Secure 2.0 Act says, okay, the deadline for plan amendments made pursuant to this is the end of the first plan year, beginning on or after January 1, 2025. So let's say you're like most people, you have a calendar year plan, and so you have until the end of 2025 while you're coping with all the things in the Tax Cuts and Jobs Act that have snapped back and that everybody's been figuring out. You also have until the end of the year to amend your plan, not only for the Secure 2.0 Act changes, but for the Secure Act, which is the original benefits legislation, the CARES Act, which was a lot of the legislation during the pandemic, all the coronavirus plan changes, the Taxpayer Certainty and Disaster Relief Act of 2020 as well. So, but again, that said, there are going to be a lot more individually designed plans. Lots more plan sponsors are going to have to come up with instead of relying on what their plan administrator is doing for their volume submitter plan, they're going to have to do their very own plan amendments and send that into the IRS and request their very own determination letter. So I would say think about this sooner than later. And let's see. All right. Roth contributions. Plans can permit participants to designate some or all matching and non-elective contributions as Roth contributions. Okay. All right. And I guess my understanding is I'm at time. I've got a few more slides left, but
go ahead. Go ahead. You got time.
I can talk?
Yes. Go ahead.
All right. This is a really great one. Small employers will get a 100% credit if their plan has 50 or fewer employees for their startup costs. Employers with 51 to 100 employees will still get the 50% credit. And there's also a credit for employer contributions to the plan on behalf of their employees for the first 5 tax years. And that's really great because that basically makes it free for smaller employers to set up plans for their employees, which is a really wonderful thing. Okay, Savers Match. This is basically for people who are making somewhat less than 71,000. Starts to phase out at 41,000, but it's basically, instead of a credit, you get basically a match from the government for putting money into your IRA or your retirement plan. Again, this is really great. It phases out between 41,000 and 71,000, so after income of 71,000 won't be there, but for lower income people, again, this is a really great benefit to encourage saving and investment for the future. Okay. Another really great feature of the Secure 2.0 Act is that student loan repayments, certain student loan repayments, and again, there's going to be a lot more guidance on this, will be treated as elective deferrals, which is a fancy way of saying contributions to your 401k plan for purposes of matching contributions, meaning that instead, if you're like, oh wait, I can't afford to contribute to my company's 401k plan, I'm busy paying off my student loans, employers will be required to treat those student loan repayments as if they're contributions to the plan for purposes of making matching contributions. And again, what's interesting, again, this is one of these, what the law requires, what the law permits. Employers will be permitted to take that group of people and run their non-discrimination tests separately. So again, making this a positive and favorable thing as opposed to making even more work for employers, which is good. Okay. Small immediate financial incentives for contributing to a plan. So this means, let's say you have an employee meeting, and once upon a time, remember how you'd walk into a bank and you open up a new account and they give you a toaster? It's going to be like that. Right now, the law doesn't allow employers to give their employees anything for signing up for 401k. But now they'll be able to have, big. They have big employee meetings, but they'll be able to say, if you sign up today, here's a toaster, basically. So I just, I love this because it's sort of. I almost chuckle because everything old is new again, and everything goes around comes around. So that's. And again, but this is only for employers with no more than 25 employees. Okay, contribution limit for simple plans has been increased. Again, employers with no more than 25 employees. Long-term care, this is huge. Let's say you have a retirement plan, like a pension plan, and they'll be able to distribute up to $2,500 a year to employees for certain kinds of long-term care insurance contracts. And these are for high-quality long-term care insurance contracts. This is huge. I just want to throw out there, if you're thinking, gee, do I need long-term care insurance? You probably do. And if you're young enough for the cost to be worthwhile, I would strongly recommend doing this. Alan?
Can you do that before 59.5, which is the lower limit? Or you don't know?
I will find out, let you know, but I'm pretty sure it's before 59.5 because let's face it, these are the kind of things you ought to be doing as young as you can. When I was in my 40s, a former employer, asked us, you have the option to purchase long-term care insurance. Do you want it? And again, because I worked on this area, I was like, me, this is great. So it's a wonderful and reassuring thing to have. Just throwing that out there. So that's something that, again, these are the kinds of things that not only should employers be doing, but telling their employees about, particularly because lots of employees will, end up delaying retirement if they can't afford to retire, if they can't afford the care they need, if their spouses can't afford the care they need. So again, things like this just make life better, make the workforce flow easier. So again, can't say enough about, how great. Of course, every, what do they say? Your mileage may vary. That's the new saying. But I would strongly recommend most people to consider long-term care insurance. All right, retiree health benefits. This is really great. Let's say you're one of those employees who still has a pension plan and it's overfunded. I know. Yeah. Randy's like, what's that? Okay. I'm actually vested in 3 defined benefit plans. So And once upon a time, lots of employers had overfunded plans, and like, what do we do with all this excess money? Because you can't withdraw it, because you have penalties, and you can't use it to get benefits, because again, your plan's overfunded, so you have more. So this is one of the options that employers have, is to use up to 1.75% of plan assets to pay for retiree health benefits, which is really great, because again, you get to benefit your retirees get to benefit, and you still, given that you have to be at least 110% overfunded in order for this to kick in, there's still plenty of cushion there, which again is important, because if the market changes, interest rates change, mortality changes, and based on all the actuarial stuff, you are less likely under this to end up being underfunded some other year. Okay, plan, this is my last substantive slide again. Plan amendments, we talked about this on or before the last day of the first plan year, beginning after January 1, 2025, but a plan has to operate in accordance with these amendments, starting with the effective date of those amendments. So there is still a lot to do before the end of 2025 to get your plan operationally in order, and then you can figure out, okay, how do I have to amend my plan, and do I need to submit my plan to the IRS and get a determination letter? And again, all these plan amendment dates are conformed for some of the other benefits legislation that's happened in the last few years. And that's all I've got.